right, let's begin. Hello, everyone again. This is Sandra Ford. I have met many of you virtually in previous webinars. We are so thrilled you are here today. And today we are going to have a further discussion on blockchain and how it's shaping the future of business and what investment opportunities it may create. So welcome. Again, thank you so much for making the time to spend an hour and a half with us. So just a little bit of introduction about me, who doesn't know me yet. I'm Sandra Ford, an operating partner here at Republic. I come from traditional finance, Wall Street finance, but at Republic for the past 3 years, I have been responsible for investor and portfolio company relations. And our team who are going to be presenting today are focused on helping companies, sourcing opportunities to bring to the Republic platform, where over 200 opportunities we have brought to our investor community. I would say in 2017 is when we started to bring blockchain-based opportunities to the platform. So you may be familiar with some of them. So as I may have mentioned in an email to all of you, this material today will, to an extent, be a complementary to our Blockchain 101 and 201 classes. And some of you I know are new to our material on blockchain. No worries, we have the recording, and also due to high demand, we may actually rerun Blockchain 101 and 201 to repeat basically the same course material as we had before.
Thank you, Sandra. All right, so yeah, Sandra mentioned this is the Blockchain Masterclass. We did a 201 and a 101 last week and the week before, respectively. And the people that will be running the class today will be myself, the co-founder of Republic Crypto. I've done a lot of work across Fortune 500 companies as a consultant, to being a project manager at small startups, and also being an engineer at, oh, I'm sorry. Thanks for calling that out. that you couldn't see my video. But yeah, I've done a lot of work from small companies to large companies, and hopefully that experience is going to be helpful for you guys and give you guys a little bit of credibility on my side on why I can speak to the application of blockchain from startups all the way to larger enterprise companies. So that's a little bit about myself. I'm gonna let Alex do a quick intro, and also our CEO Ken, and then I'm gonna go straight into the agenda.
Hey guys, and look, feeling great to see so many familiar names in the chat. Welcome back. Today, I'm gonna be excited to tell you more about, how we diligence companies, some more in-depth conversations that you'll find Brian and I and other industry people, and how we evaluate companies in the blockchain space. Previously, for those of you who are new, I came from a traditional VC background where I worked for both a venture fund of funds doing institutional allocations in the venture, and also direct for a Chinese private equity company. And for the economic side, I studied that at U Chicago. So yep, I'll pass it on to Ken.
Good afternoon, everyone. Thank you so much for taking the time to join us today. I'm a co-founder at Republic, and it's been a thrilling 4 years to have like-minded partners in crimes like Sandra and Brian and Alex, so that we're aiming to build something that's different and hopefully a more democratized, accessible world of private investing powered by blockchain technology. There's a section for me later on to share with you my perspectives on how this technology will fundamentally change financial services and financial technology overall. So really looking forward to it. Just a very quick background. I was a securities attorney at one point. I went back to academia and spent some early years at AngelList, but also in traditional finance, and this confluence of legal, technology, and venture capital really had bring us to where we are today as an industry and an organization. Back
Awesome.
to you, Brian.
Thanks, Ken. All right. So today we're going to be talking about quite a few things. We're going to start off with the blockchain deep dive with myself. Alex is going to take us through some of the industry landscape, like, what is really out there? What does blockchain actually touch? And then we're going to go into some token economics, a little bit of economic theory for you guys. It gets a little bit technical, but in a fun way. And then Ken is going to lead us into blockchain applications in fintech, as well as some key legal considerations when talking about tokens, talking about fundraising, and just like the general compliance and legal landscape and how it pertains to blockchain. And after that, I'm gonna wrap it all up so you guys can kind of like hear it all again and hopefully help absorb some information. And then we'll take you guys right into Q&A. So, and before I start diving into it, I do want you guys to know that I will be monitoring the chat. So if you guys have any questions, please pop it in the chat. I'm gonna try to answer them live as I'm going through our parts. And we want to kind of keep it pretty engaging because the last thing we want is for you guys to get lost and kind of like have the information kind of glaze over you guys, because this is some pretty deep stuff, but we want to make it as engaging and intuitive and fun as possible for you guys. So don't hesitate to throw questions in the chat. All right. So deep dive. So we're diving into some pretty advanced concepts today, and that's because we're building off of some of the material that we went over in Blockchain 101 and Blockchain 201. But I do know that there's a lot of newcomers on the call today, so I will be trying to keep things light and also keep things on a level that everyone can understand. But going right into it, smart contracts. I know that a lot of people have asked about smart contracts in the questionnaire leading up to this session, and essentially, like, what are they? Like, is that a blockchain thing? The answer is yes. Smart contracts is essentially a way for you to create programmable money, and that's uniquely enabled through blockchain technology. And a quick way for you guys to all kind of like understand how that works is sports betting. I think everybody kind of understands the idea of sports and betting. And typically when you do that, you place a bet, at a casino, or you place a bet, online, and there's some broker that handles it. And when that broker handles it, they take some sort of fee and they kind of like, verify the outcome and all of that. And when you get the payout, you're not getting true odds. You're getting close to true odds, but you're not getting true odds. With smart contracts, you can actually create logic and rules. So for example, if Shiva and myself are like betting on the Los Angeles Lakers to win the NBA championship this year in Florida, we can both enter a smart contract and say like, hey, I'm gonna put in some money, and then based on the outcome of that bet, we can the smart contract will automatically pay the winner and debit the loser. And there's no middleman to take any fee or any cut. And that's just a very simple application of smart contracts that if you extrapolate that idea, you can really apply that to many things. So think about like escrow for real estate. Think about just general financial transactions where you're depending on a third party to like kind of broker the deal, but you don't need them to do it anymore because that brokering is done through a computer code. And that allows for the creation of like these applications that remove the third party out. So that like kind of innovation in blockchain will really cut costs and make a lot of things way more efficient. And the type of applications that leverage this are called decentralized applications, aka dApps. This is a word you guys may have heard in the past. But dApps leverage smart contracts to create these programmatic, systems. They can be as simple as like a betting platform, or they can be as complex as like a banking and lending platform. But all of them will help reduce costs by getting rid of like some, centralized entity or disintermediating a middleman to allow for the end users to save costs. And again, if you have any questions, Alex and Ken will be on there to just kind of like help clear up the concept as well. But I'm going to dive into the next concept, which is what I would consider a little bit more advanced. That's called hashing and cryptography. You guys all hear like, blockchain and crypto, but like, what is it about blockchain that's actually crypto, right? And in 101, we talked about how blockchain is essentially a database architecture that chains together blocks of data. But when those pieces of data are chained together, like what keeps those chain links secure, and that's cryptography. And the way that works is, let's just talk about sending Bitcoin. I'm sending Bitcoin to Mike here, and after I send him a piece of Bitcoin, that transaction is added to the Bitcoin ledger. When that transaction is recorded, that transaction becomes encoded through cryptography, and then stored on the main Bitcoin blockchain. And then if Mike sends Bitcoin to Sandra, that now Mike's, and Sandra's transactions all get encoded again. So every time a new piece gets added to the blockchain, it gets encrypted and encoded again and again, hence becoming more and more secure. And that's how cryptography is baked into blockchain. And that's why people use the word crypto when you're talking about certain blockchain tokens, because it's all using cryptography to secure and keep the ledger safe. Another thing that I want to go into is consensus. A lot of you guys have asked, like, proof of work versus proof of stake. What are they? And if those of you that tuned into 201, you'll know that consensus is the way that, yes, I will go into the diagram. Good question. A lot of you guys will know that when I talk about like adding the blocks to the blockchain, like how do all the different nodes know what's the right block? And that's how the consensus mechanism works. They basically have to come to an agreement on what the next piece of data is. And the way that happens is called proof of work or proof of stake. Those are different types of mechanisms. I'm not going to go super deep into it because it is a little bit complex, but I want you guys to understand that there are mechanisms that are in place to ensure that the different nodes of a certain blockchain come to an agreement on what the true amount of data and what are the true pieces that are part of the block. So going into this diagram that I do want to explain for you guys is that, you know, for each block, we're talking about block 1, block 2, and block 3. Let's just say block 1 is me sending money to Shiva, and block 2 is Shiva sending money to Sandra. When I send money to Shiva, that block 1 gets secured through cryptography, aka it gets hashed. So that you imagine that one block is hashed. Once Shiva sends money to Sandra, it'll hash the data of mine and Shiva's transaction on top of Sandra and Shiva's transaction. So both of them, it's like almost like it's like a hash inception, right? You're like hashing one, but then you add another transaction, you hash that whole thing again, which means that the previous transaction is encoded in the hash of the new transaction. Therefore, you cannot kind of like change that information anymore because it's like baked into the hash. So that's how the chains of data in a blockchain are all tied together, because the latest block of information has information from all the previous blocks before. And that's why when you think of blockchains, you think of a kind of like a secure ledger of transactions. So I hope that was a little bit more clear. Yes, concentric circles of hash, like everything is hashed into each other so that, you know, the latest piece of information actually depends on all of the historical information before it. And therefore, if you change anything in the past, it'll affect the latest information, but then, you know, you can't do that because everybody has an agreement on what the latest information is through consensus. I do want to talk a little bit on and that's what makes it immutable. That is correct. So you can't really tamper with old information because the hashes depend on it. And that's why blockchains are so secure. I do want to tackle the blockchain trilemma, which is the other image that's right here. When you think of blockchains, and especially as everyone thinks about how to invest in blockchains and how to like think about them and how to evaluate them, you want to think about scalability, speed, and decentralization. These are three main concepts that every blockchain has to deal with, and it's impossible to have all three of them be like 100% the best. So there's always like a little bit you have to like pick and choose what you want. If you want a blockchain that's really scalable, as in like really fast, and you want a blockchain that's really decentralized, it cannot be super secure. But if you want one that's really secure and really fast, it cannot be super decentralized. So think about it that way. And these are really important for applications that you want to invest in. So say you want to build like a payments blockchain, you probably care about speed and security, but you don't care as much as decentralization. You know, so like just think about like the application and think about which of the 3 pieces of the blockchain that are best suited for that. So those are like some advanced concepts that I want all of you guys to kind of take away and think about and build on from the 101 and 201 sessions that will help you like better understand and evaluate blockchain projects. I see some questions in the chat. Let me just look at it real quick. Actually, some of these are a little bit more complex, so I'm going to address them later offline or on a blog post. All right, I want to take it to the next section here with Alex, the investment landscape. So now that you guys kind of understand some of these more advanced concepts, now you can know where to apply them. And Alex is kind of build on some of these ideas that I introduced to you guys and how blockchain is applied to many different landscapes based on like the technology that is now enabled from blockchain. Go ahead, Alex.
Thanks so much, Brian. And hey guys, it's Alex again, and I'm gonna go ahead and rely on a lot of your guys' experience as experienced angels or venture investors to talk more about how you guys can evaluate the whole space of blockchain and where you might consider investing depending on its different factors. So next slide. Awesome. So first thing to remember as a crucial takeaway from our last couple sessions is that crypto and blockchain are different. In general, a crypto asset or a digital asset is a new asset class entirely, whereas the startup equity of companies that service the blockchain industry or use blockchain as part of their services, issuing that equity is no different than a traditional VC investment. So in that sense, what are the differences in these 2 asset classes? The main considerations for you guys would be that the exit horizons are massively different. That in traditional equity in a venture space, anywhere between 7 to 10 years, and that in crypto might be anywhere between 1 to 3. And so why is that? One of the major reasons is because there are massive exchanges now, say like Binance, Huobi in Asia, and then Kraken, Coinbase in North America, that help us get liquidity from these crypto assets we have. And in the current stage of blockchain's development, that liquidity and the reputation or security of that brand is massive leverage. But a key fundamental intuition about both is that the earlier you back these companies, the better pricing and favorable, lockup investing periods you'll get. So the same basic fundamentals apply, but just on different time horizons. And that's good for the next slide, Brian. Awesome. So let's think about, VCs and angels. We're in the business of creating value by backing these technologies to create, in a sense, a more productive, better world. And so I wanted to talk about infrastructure and adoption. So for example, when we had the internet, before we had all these great websites to use, and when we had that .com boom, internet was dial-up, and there were a lot of people working on straight up the building blocks or the pathways in which the internet would work. And that is what I call infrastructure. And blockchain is very much the same. And in that way, it is certainly a necessary but insufficient in itself to create value. As an investment, infrastructure tends to go towards the bottom, AKA someone's always going to find a way to build the same infrastructure cheaper and for a lot more people as a result. And as a result, the applications that are sort of enabled and built on top, those are the real value creators. However, and as we see through multiple waves of technology, those infrastructure giants then become the biggest buyers in this ecosystem. So whether that's cloud services or internet or payment systems, the big names already: Google, Amazon, Tencent, Alibaba, PayPal. So in order to get access to a lot of these applications, one route is to back the infrastructure, even if the infrastructure at first is not the value creator. So that's how we think about how do we optimally fund the blockchain and crypto space. Next slide, Brian. Awesome. So when you guys might see different themes on the internet across different regions, right? And I want to talk about three today: North America, Asia, and Latin America. And a good way to understand what initiatives we're seeing in each of those regions is to look at their fundamental economic qualities. In North America, we have the most VC dry powder, aka deployable capital, from venture capitalists. And we have some of the highest regulation on how we carry out crypto and blockchain. And so this sort of leads us to be constricted to focusing on the R&D, the technology, that infrastructure. So you'll find companies like Coda Protocol, Ava Labs, Hedera, Hashgraph, and more that do everything from help blockchains talk to each other, like Brian said, with interoperability. And some are trying to make proofs or functions that are much less computationally heavy than a traditional hash function. So in that sense, we're really the R&D capital of the blockchain, or at least North America is. And then moving on to Asia, very different landscape, though the gap is sort of closing now. But Asia has a massive, massive population, especially in China. And the big difference between a lot of Asia than, say, the US is a lot of its users are mobile native, meaning that a lot of the applications they have first touched have been on a smartphone rather than a computer. And so you'll see a lot of Asian blockchain companies, as an example, really tackling the adoption first. How do we get a crypto wallet or crypto application on somebody's phone, and then from there increase the value in which it generates for them? So that's Asia's approach. And then another super interesting region, Latin America, right? This one is really different here. So with Latin America, there is actual geopolitical and economic instability, say like in Venezuela. So in that sense, you're going to find immediate user demand in those nations where people need to be able to store value in the midst of their government's own stagflation, or they're going to need to transact digitally and securely to vendors, because cash, an individual bill of cash, is simply worthless, and carrying around a ton of them is just completely inefficient. So that being said, Latin America is really focused on the Bitcoin ecosystem, because that is the first and functioning ecosystem we've been building on. And so you'll find companies like Coinbanks and Money on Chain helping those regions, both on the enterprise and the consumer side, use blockchain for the day-to-day. Awesome. So tokenomics, you guys might have heard the word in plenty of different places. What does it mean? Is it scary? These are all things that are meant to scare off people, and I'm going to be here to tell you that token economics is the least scary thing out there. So let's go ahead and roll that slide. So just to recap on 201. So token economies are fundamentally the same as traditional economies. So that, first off, that's a number one takeaway I want you guys to have. And generally, there are three different behaviors that I've identified. And now these will definitely differ from the legal classifications of them, as Kendrick will talk about. But economically, we sort of see three different functions of these tokens. The first being securities. So for securities, you always want to understand what are the underlying assets or future sources of cash flow that are backing that token. So for example, if I want to tokenize, or there's a company that wants to tokenize houses, then you'll want to understand what houses are linked to these tokens. And if it's backed by profits, you want to be able to identify those, because essentially that's the one-to-one translation of value from the off-chain world to the on-chain world. And then secondly, we have utility and currency. And this one you guys are all probably very familiar with. It's about net present value versus future discounted value. So with this, it's just like cash, right? Idea being, would you rather spend cash now to consume, or should we try, or would you rather save it in a bank account, much like our traditional financial infrastructure allows for? And now, now we're moving on to governance, and I'd say probably the most philosophically interesting topic, which is the idea that we can opt into a system and make decisions collectively, and through a cryptocurrency, invest in a stake of that organization, and via other people, increasing the population of your, if you will, like little virtual nation, increasing the overall network value over time, thereby making it a type of investable good. And so those are some of the three major behaviors. And now let's walk through some of the fundamental economic variables that relate to these value propositions. Awesome. So tokenomics. I know there's a lot of text on this page, but at least my motto in every company I look at is the simpler, the better. So first of all, and a lot of you are already experienced venture and angel investors. So the first thing you always want to look for, regardless of the technology, is value proposition. And blockchain is no different. So from here, you'll always want to understand, is this blockchain being optimized for transactions? Is it being optimized for store value? Is it being optimized to track enterprise data, right? Every company, regardless of what technology they're using, needs to identify the market they're going to target and how they're going to carve that out or dominate it. And then on the market clearance side, or the design of that ecosystem, how are we matchmaking users and developers, transactor to transactor, buyers to sellers, right? You need to have a way to make those prices, whether that's centrally determined or determined by seller or determined by buyer, right? And from there, you have to, how do you compensate the validators who are, say, in the case of Bitcoin, putting in computational work to ensure the security of the network? And then finally, how are you compensating stakers for locking up capital for the benefit of that network? So in essence, how is every participant in the network being properly incentivized? And that will determine the long-term lifespan and growth of that company or network. And then finally, on the technological side, blockchain architecture. There are way too many terms to go into, and each is a research paper. But in general, you want to take into account a lot of these factors. So for example, for block times, you might hear a lot of people talk about Bitcoin as having long block times. And that sounds like a bad thing, but I'll tell you right now that between tokens that want to accrue value as a storage versus those that want to be transacted, difference in block times actually can be very beneficial. So for block times, the longer that block time is, if you think about it theoretically, it means that more capital is being locked up for a longer period of time. And that will, in the midterm, stabilize the network more than a block time that is shorter, which allows for very efficient transactions, right? And that will generally drive the price more down and more drastically than that with a longer block time. And then moving from there, you have like the security, and some of you guys have definitely probably heard of the 51% attack. And what that means in diligencing any crypto economy or blockchain is looking at the miners and validators. Is there a possibility that because if you have 100% of the network, you can maintain decentralization even if it's split evenly right between two people. But if one miner owns even 51% of the network, then they can control the majority by definition of the nodes, and that can cause basically cause a major rift and ultimately attack on the overall system. So now moving on to our financial considerations in the financial and capital raise. Like every company, you always want to know, if we're going to give you that money, what are you going to be using that for? What's the cost to build this network out into something robust? That's very important to know, just like it would be for any startup. And then next, investor incentives. Whenever you're evaluating an investment, you want to know what price you're getting in, what's the valuation of the network, and what proportion of the network is being sold to you. And then finally, is that price any different than any other investors? And many of you who work for your own companies and such know that there are vesting periods and lockups on the equity or stock options you have. The same works for cryptocurrencies if the company chooses to. And so that's just to make sure that you're aligned with the management company in the long-term growth of that network. And then finally, it's monetary policy. And this is all the boring stuff you probably learned in Economics 101, which is, how do we restrict or increase the supply of our currency? Much then that works exactly for companies as well. Do we choose to issue more shares, or do we want to buy back and burn more shares? And then from there, how do we additionally reward our stakeholders through dividends? And that's probably one of my favorite use cases of crypto, is that you can make borderless micropayments to hundreds of thousands of people, maybe even millions across the world, with what we call stable coins, which are essentially cryptocurrencies that are pegged typically to the US dollar. And that is just going to be so much more efficient, both in terms of cost and distribution, than it would be, say, manually. And then now let's look into governance, right? And this is the one that, again, I mentioned was the most complex, because in essence, it's really tackling how humans make decisions ourselves and how we might use technology like blockchain to automate that. So in my opinion, that human behavior precludes governance, but here's some of the mechanisms that blockchains will advertise they use in order to make that process robust. So the first is reputation and identity. And like Brian talked about, we want to have a trustless network. And here, that means, how do we preserve everyone's anonymity or hiding their actual identity, but somehow be able to track their reputation on the network so that their opinion, previous behavior, and things of that sort are all kept track of. And then the next is, proposal and decision process. Just like the US Congress has its own way of proposing a bill and passing it through different houses of the legislative branch, how does a blockchain governance protocol handle the origination and processing of proposals? And one example is the usage of linear voting versus quadratic voting. So a lot of you guys will definitely be familiar with the idea of a lottery, where they're trying to maximize how many tickets we all buy. And therefore, each additional ticket is priced the same as the previous. This is so that your chance of winning is proportionate to how many tickets you buy. But you don't necessarily want that in a democracy. Otherwise, those who are the richest will control the largest decision-making power in that network. So quadratic voting is when you price essentially every ticket higher than the one previous, and you adjust that curve depending on how much you want to disincentivize it. And then finally, and the last two, we have conflict resolution. The default thing to do in a lot of Bitcoin and a lot of blockchains is to fork the code and start a new community. And that's probably the biggest risk to volatility and the overall unity of the community we have. And so how a governance protocol might resolve conflicts through a variety of different creative mechanisms is definitely should be taken into account if you're interested in getting into the governance space. And then finally, Oracle problems. So a lot of companies in the blockchain space are trying to track real world assets onto their chain. And so whether we're talking about real estate, company stock, even straight up cash, then we need to rely ultimately on someone who is off the chain. And being off the chain means that they're not following the same decentralized protocol as those on chain. So we need to be able to trust those sources and bring that information. And this can be done through, say, a legal contract, which is then digitally executed. and then stored on the blockchain that guarantees the linkage between a token and the asset it claims to be linked to. And yeah, those are some of the main 3 categories I like to look at in token economics. And overall, guys, start from the simplest and only ask about complexity as it comes up, because not necessarily every blockchain is or should be as complex as with all of these factors in mind.
Hey, Alex, it's Sandra here. Would you mind giving an example for the real world assets for governance piece? Maybe, yeah, if you could give an example, that would be helpful.
Yeah, for example, for real estate, for example, we want to say take a real world offline asset and then bring that on chain. Now, if we don't have any sort of contract in place or legal document that asserts that this token is linked directly to that asset, then we don't know how we can trust the blockchain to be able to transact with that asset. So when we think about oracles, we need to basically establish what is a sufficiently trustworthy method to ensure that that off-chain or say real estate asset is actually guaranteed to be linked to the data that is on this decentralized network.
Hey, I think another interesting example, not related to real estate, would also be in the kind of finance industry. So in the decentralized finance or DeFi space, basically there's a project out there called MakerDAO, and you can hold their native token called DAI. And the more DAI that you hold, you can actually vote on interest rates that are part of that system. So people that lock up tokens or invest tokens, there's certain interest rate returns that exist in that ecosystem. And the people that hold the DAI token can vote on these interest rates. And that's another example of how holding multiple tokens or holding certain types of tokens can give you a say in the ecosystem that it pertains in. So so governance is a super interesting place for tokens and token economics, because they're not only are these tokens, they can appreciate in value and can be used as an investment vehicle, they are actually used to actually make change or actually evolve the product that they are in. So hopefully that kind of makes the example a bit more clear for you guys. Yeah, no, I just saw something in the chat. Josh, you're totally right. The DAI is a stable coin. The Maker token is the voting coin. That is totally correct. There are 2 tokens in that ecosystem. One is a stable coin. Another one is more for holding and for voting. All right, let's take it to the next section here. We are gonna go into blockchain applications in fintech. So Ken, do you wanna come take this away?
Yeah, definitely. Thank you very much, Brian and Alex, for super helpful overviews. I think this is more content rich than my physical chemistry class in college, though admittedly that was quite some time ago. The topic that I'm going to touch on is how blockchain technology apply to fintech. There's a legal implication behind that, and there's the business implication. If you allow me to take a step back and define fintech a little bit, within financial products, there's the public market, and that's what most people think about when they think of investing, right? It's being synonymous with buying and selling public stocks. For most wealthy investors, though, they invest a significant portion of their portfolio in alternative assets. It's a busy term to describe private equity, venture capital, but also real estate and hedge funds and even art. Now, based on some studies, some 30% of certain high net worth investors' allocation or assets are allocated into just real estate alone. And the reason for that is that these types of assets can generate much higher returns than stocks and bonds. And the reason why up until fairly recently, ordinary investors, meaning retail investors, those who are not multimillionaires, rarely invested in them because not only that they are unfamiliar with these asset classes, but that these assets require a very significant amount of capital to access, meaning very high minimum amount of investment. So when it comes to the term fintech, I think the technology side of it is basically using technology to make investment products more accessible, right? And we've seen that with Robinhood, we've seen that with Betterment, and I don't think that there's a technology before now that has been or will be more impactful to financial products than blockchain technology. So it's not too much of an exaggeration to say that blockchain puts the tech in fintech. And now, how is that possible? How does it make financial services and financial products that much more efficient? Why don't we just go quickly over a few points here? One is that blockchain allows for increased efficiency in financial instruments by digitizing traditional assets. What does that mean? It means that when you take a single stock, a single share, or even let's say this cup is an antique, cup by, I don't know, some Duke in the past, you can digitize it. You can break it down, the Mona Lisa even, to fractional pieces and record it, and based on the ability to transfer them digitally, but in a secure, verifiable way, that's definitely a leap forward in a way that up until now, for a couple of centuries of financial products in the US and beyond, we haven't been able to do. The creation of a secure historical ledger of transaction, as I mentioned before, is a key component of enabling digital assets and transferring them in a way that doesn't require physical documentation. The automation of financial steps through smart contracts, what does that mean? It means that when, let's say, I were to sell Sandra or Brian a share, in the old days, you got to go through transfer agent. You got to go through attorneys to verify that Sandra is, based in the US, or that at least she's not based in Tehran. We currently have some sort of sanction going on with certain countries. So KYC, know your customer, AML, anti-money laundering. All of these pieces that would enable a proper compliant financial transaction used to be handled by intermediaries, and these are massive corporation, fund administration, credit report, all of these things are intermediaries that are already being disintermediated and over time will be replaced by blockchain automation altogether. And the fourth key component is the borderless transfer of value, the ability for one party, one person wishing to make that transaction, being in a different country, let's say in Mexico or Vietnam or Ecuador or England, to invest an amount of money into, to a party based in the United States. Let's say, for example, currently on a platform that we all have that you guys know about, Republic, the minimum investment amount, some of which is $10, other deals are $50. That's already is a huge step forward compared to minimum investment in the traditional days, and that's a reasonably small amount for someone in either California or Alabama to invest on Republic. Without blockchain technology, it is not possible for someone from Ecuador to invest $50 into a deal on Republic. Why? The international, the wiring fee, cross-border transaction to facilitate $50 in investment, or the transaction worth $50, the fee to do so itself is already that amount, right? So it doesn't make sense for anyone to do that. What does that mean in the old day? That means that you got to invest, I don't know, $500, maybe $1,000 to make that $50 transaction fee worth it. And that's a lot of money for people in Ecuador. So if you can, with blockchain technology, itself is a form, a medium of exchange, and you hear the term digital currency because people do use it, some form of it, as a payment tool, as a currency. The transaction fee can be a few cents, even less than a cent. So that ability to enable transactions cross-border, free of the banking, international complexity and limitations, making it possible for people to invest small amounts naturally will facilitate the flow of money around the world, and that by necessity, almost by definition, will lead to a more robust, more vibrant financial market and a more vibrant economy overall. I'm going to use a couple examples here. JP Morgan has a digital currency. Now, JP Morgan is a massive bank. They have many counterparties, that is banking partners and other clients. They are the largest bank, I believe, by asset in the world. The process internally, the reason why they have to issue a digital currency is that the process to settle payments, transaction, let's say Alex is a multimillionaire based in Russia and Brian is a multimillionaire based in LA, and the two of them transact with one another through the JP Morgan framework. The process of recording Brian's, fund, let's say Brian is transferring that to Alex, settling it with a central account within JP Morgan, recognizing that currency, balancing it and transferring it back to Alex. That has been done for the past, over 100 years of JP Morgan, but it's highly inefficient. It's not unlike how a treasury like the United States or that of Saudi Arabia or Kuwait, that how they transact interbank settlement between Citi Morgan and JP Morgan. It have to go back to the central bank of the United States. The central bank need to figure out that process of settling the payment. With digital currency, and the JP Morgan digital currency is only used internally. It's used to make that process more timely, almost real time, more efficient, and thereby over time added value. I don't know if you guys have seen in the news, but very recently that PayPal and Venmo are soon to enable crypto payment infrastructure so that you no longer have to, load your credit card or debit card, but that perhaps someone from Ecuador with, 5 Bitcoins or 1 Bitcoin would be able to make a payment and buy some product from whatever vendor that also accept PayPal or Venmo, but accept that such a transaction using Bitcoin or Ethereum. Currently, it's very difficult for someone externally outside of the United States to use PayPal and Venmo efficiently because of the inherent border limitation associating with any one country's currency, including the US greenback. So, long-winded way of saying that this is one technology, just a very quick recap here, that will make it possible for more people to participate in investment products, right? It doesn't matter if it's real estate or whether it is an early tech company, both which are in Republic, but these are all different asset classes. Blockchain technology will enable the fractionalization of that, the automation of the requirements that one would need to go through to invest in financial products, and would make the flow of fund more efficient. Because this enable more people to get in, naturally the whole legal landscape that apply to securities law or investment product come to apply to digital assets in a major way. The legal implication here is that the history of how you guys have all heard the term ICO, initial coin offering, and in the years 2016, 2017, a lot of projects raised a lot of money from anyone could invest globally. And a lot of people did, get, if not rich, then certainly got a sizable return. And there are tons of projects also disappear. What were these people doing, and why is it that they kind of like all of a sudden that whole ICO, boom, the fascination with it kind of like fizzle away? Well, a new ICO, a new offering of a digital coin is, at least in the United States and in many countries, is generally run a high risk of being deemed an offering of securities. So the ICOs of the 2016, 2017, era didn't really comply, basically ignore all of the legal implications around token distribution or around investment products altogether. What's the key distinction there and what's the argument there? To give you an example, if I'm today offering to sell you this coffee, this mug, there's no securities law issue apply because this is straight up a product, a commodity. But if I were to say that, hey, Candice Go, we're gonna offer you shares in Republic, and if you put money into this, into Republic, and we, Alex and Brian and Sandra and Ken, work really hard, maybe these shares a year from now will be worth 10x. If you invest in something and you expect other people to work on it in anticipation of a future return, well, that fits under the definition of a security under US law. Obviously, with a lot of these new tokens and these projects, you can call it whatever, but when you issue this digital asset and you sell it to people, people invest, not to use them to buy things, not to use them to exchange for a coffee mug or a ticket, but use them, hold on to them, hoping that by the effort of the project that over time these tokens will be worth 2x, 3x, 20x more than the purchase price that you pay. If that's the case, then that token is likely deemed to be a security, not from the perspective of save or not save, but as an investment contract, a security instrument that is governed by US securities law. If something is governed by US securities law, then the person issuing them gotta make sure that you comply with the framework of distribution, and the trading of that instrument also is highly regulated. The project that do not apply or ignore the legal foundation and the compliance framework behind a token offering ultimately either gonna fail, or if they succeed, they're gonna run into problem with the SEC. So when you conduct due diligence on a new project, aside from all of the consideration that Alex had walked through during his session, the assessment on whether this project is compliant, is legally robust. Do they have advice of legal counsel, of credible law firms? Have they thought this through rather than just willy-nilly offering a new investment contracts to the world? I think it has very, very significant implication on your ability to yield a return or for the project to be successful altogether. The legal and compliance concepts, there are four main ones. The first one is, as I just mentioned, the distinction between a security and a utility. That is it in the traditional world a coffee mug or a private share? In the case of blockchain technologies, the difference between something that you can use, literally something that you can use to trade for the right to attend a webinar, for the right to use or to go to an event, that's utility, versus something that you simply acquire, hold on to it, and expect there's a return. That distinction is still something that every project has got to make. Once that piece has been made and it's deemed to be a security, then the question is, how are you going to fundraise for that? And how do you do that and still make it accessible to non-accredited investor? If something is a security, unfortunately, naturally, in order for you to make that security accessible to non-accredited investors, you got to go through either a similar framework like the offerings on republic.co or a more complex framework known as Regulation A. There's 4 different types of securities offering privately in the US anyway. It's called Regulation D, available to accredited investors only or millionaires. Regulation S, that's for non-US, and the offering must not touch a US person. Then you have a Reg A and Reg CF. These two framework enable the offerer or the issuer to basically take in non-accredited participants or investors, but they gotta jump through a few complex legal hoops. Outside of these three frameworks, the only way typically for a project to offer digital tokens to non-accredited investors is if the token is a utility token, and that's a very rare case, or if that project is already a public company and the token is qualified to be offered to, to the general public. So again, Reg D, Reg S, only either accredited investor or non-US investors. Reg A and Reg CF would be open to everyone, including non-millionaires. And Republic does Reg CF and also Reg A. And outside of this framework, then you have the world of IPO, the public market. The instruments that we use to conduct these offerings vary case by case, where there's a SAVE, where there's a SAFT. As an investor, obviously, I know that these are complex legal documents, but usually online, there's somewhere a layman description, a friendly, normal English description of any of these instruments. So if you ever see a legal instrument that you're like, what the hell is a token, debt purchase agreement, or what's a SAFT, a security, simple agreement for future tokens, just Google it for an explanation. You're likely gonna find at least a few just normal analysis and description of what these tokens mean. And as I touched on earlier, if something is a security, you, in addition to making sure that the people who purchase these things are either, sophisticated millionaires under Reg D, either they're non-US person under Reg S, or if they're non-accredited, then they got to comply with Reg A and Reg CF. In addition to that, there's a requirement that you got to make sure that you're not selling these things to those who are looking to, launder money, and that there's a general obligation of knowing who the investors are. These are things that are a little bit antithetical to blockchain as an industry, because there's a concept here that you're freely decentralized, right? Fully democratized, not relying on a central party, not even on the government. But unfortunately, when it comes to financial products, there is that requirement in the near future that someone is going to be on the hook for making sure that securities law compliance is adequately observed. And because of that, I personally believe that the world of DeFi, decentralized finance, there's a significant component of centralization in the near future.
Thank you so much, Ken. That was, I don't know if you guys recognize, but you guys were all in for a treat there, because having an actual securities attorney explain all those concepts is a pretty rare occurrence. So Ken, really appreciate that. And also Alex, thanks for the breakdown of the landscape and the deep dive into the economics. I'm actually going to recap some of these concepts for you guys. And, we have about, I want to say 25 minutes left. So I'm going to do a recap. And afterwards, we're going to open it up for questions, because I know you guys all have a lot of questions. My screen's on full screen, so I can't see all the Q&A, but I see that there's a lot of them. So feel free to throw them in the chat right now, and we're going to get to all your questions. So we really hope that this was super informative for you guys. We wanted to take some time to really introduce and build upon these concepts for blockchain and cryptocurrencies, because it's not really a scary technology. There's a lot of new stuff happening. It's been around for quite some time, but in the scheme of technology, blockchain is still very nascent. People like to throw around the phrase that blockchain today is very much like the internet back in the early 90s. We're still figuring out the fundamentals. We're still building the infrastructure. A lot of mistakes are being made, but it's kind of cool because it's going to lead to some really cool stuff in the future that we don't know about yet. So, we're learning about this as you guys are, because there's still a lot more to do. So a lot of these innovations are being explored across many different industries. And, as far as the technology itself, I think like from a technical standpoint, it is at a place where it can be applied to many industries. So like some of the concepts that I explored, based on like what makes a blockchain immutable, or how does a blockchain work, is just basically a type of database architecture that completely allows you to digitize, traditional objects, and allows you to create these kind of smart contracts where you can programmatically execute transactions that historically needed to be done by pen and pencil and paper and with people. But now that you don't have to, you can make things go faster. You can make things be more efficient. You can make things go borderless. So something that I tossed around in Blockchain 101 is that we think that something that blockchain is going to do for money is, if you think about what email did for sending mail, you can kind of translate that to how blockchain is going to do for money. You can send it anywhere. It's instantaneous. There's no borders. It's fast. It's easy, and it's really just saves cost and time. So that's just like the beginning of what we're looking at for the applications. And as Al kind of went through some of the industries that blockchain can be useful in, I wanted to add that yes, financial applications are really like strong, and the finance and fintech industry is ripe for disruption through blockchain. But there's also a lot of cool stuff happening in gaming, a lot of cool stuff happening in arts and music. Just so you guys can have some early ideas, like blockchain allows for this creation of digitally unique items, right? So if I send a Bitcoin to Nadia, I no longer have that Bitcoin, and Nadia has that Bitcoin, and that's the very first time that I can send something that's digital and no longer have it. Right? Imagine if I sent a photo to Nadia, right? Like a picture of my dog. I will still have that picture of the dog, and now Nadia has that picture of the dog. Like now there's two photos. But with Bitcoin, if I send a Bitcoin to Nadia, like it's transacting on the blockchain and I no longer have it. So imagine like digitally unique items, and think about games, like digitally unique skins, digitally unique weapons, digitally unique characters. Like you're the only one that has it, and now you can create this type of scarcity that wasn't available before. So it's just really like a new way to like think about businesses, and a new technology you can apply to like traditional industries. And like these digital tokens, right? Like each of these like these skins can be represented as a token, and these tokens that have been born from blockchain have now like ushered in a new era of applications, of business lines, and even just like businesses in general. So we don't have the answers for what all those are going to be, and we're just kind of trying to teach you guys the building blocks and helping you guys establish fundamentals on how to think through these things. Because at Republic, we see all sorts of business ideas come through in terms of companies that want to fundraise on these cool ideas, and we're inspired every single day. And it's really cool to see all these ideas. And I'm sure a lot of people listening are either investors or startup founders. Like these are just like cool concepts to be like thinking about on a day-to-day basis for how you can leverage blockchain and tokens for your business, even to make things a little bit more efficient and effective, right? So Alex, I see you kind of going off of mute there. What's up?
Oh yeah, I wanted to, hop on to describe a pretty fundamental like intuition for determining the value use case of blockchain that I went over in 201. You were talking about a lot of other industries where we essentially are looking at intellectual property or unique goods. So when thinking about where blockchain can make things more efficient, for example, it's not going to ever be faster than, say, Visa on the payment transaction level, simply because in a situation where you have financial transactors, you already know who you want to send it to, and you just want it to happen fast. Where blockchain can really help is where there isn't sufficient trust between those two parties. So whether that's licensing out intellectual property, whether that be a technological patent or rights to a song, those transactions can be finalized sooner with blockchain. And that's where the technology can help make a process more efficient. But in the financial world, for something as bare bones as financial transactions that we're just sending money with, at that point, we might as well just have maximum throughput, because that's what consumers want. So it really all depends on where you're going to be using that blockchain, because collective decision making, whether we like it or not, will always be slower than centralized decision making.
Thanks, Alex. I see some questions in the chat regarding how blockchain can be applied to some industries, and I can actually speak to them. So the first one is pharmaceutical, and I do see one about the music industry. We've actually seen projects from both at Republic, so I can definitely shed some light there. So as some background about myself, I've actually worked in the pharma industry for a few years in the past, and having worked there, I can definitely say that blockchain can really help make that industry more efficient. And I'm talking about specifically supply chain. And when you talk about blockchain as a ledger that records transactions, it's not just recording like, monetary transactions. It's not just recording me sending Bitcoin to Sandra. It can also be, the life of a drug that's being made from raw materials. You have your active pharmaceutical ingredient and your raw materials that eventually become packaged into a final product that's shipped to the doctors and the clinics. You can actually use the ledger enabled by blockchain technology to track every step of the way that each drug is being taken through, and you can verify each step because a blockchain is an immutable ledger, and that way you can make sure that every piece of pharmaceutical ingredient or every drug is completely verified and not a counterfeit drug. And if anybody's in the pharma industry, you know that counterfeit drugs is a huge problem. So applying blockchain technology to ensure authenticity of the supply chain is like a super huge and awesome application of blockchain. And I can definitely see large companies already exploring that. The second question I saw is the music industry. The music industry, and there's a super great point here. The musicians are actually at the bottom of the food chain in the music industry, meaning like out of all the money that's made in the music industry, musicians don't get their fair share, even though they are the creators. A lot of the money goes to like the label, the platform, the producers, and all of that. And with blockchain, you can actually trace, the song being played back to the musician that made it, and you can then make sure the musician gets paid equally. And because blockchains are an open source and the ledger is something that anybody can read, then you can actually verify what percentage of the funds are actually being paid back to the musician. So there are projects out there that are working to do this. So for example, if you're on like, a Spotify or a SoundCloud, you don't really see the flow of money because you don't get access to their backend database. But if you're building on a blockchain such as Ethereum, then you can actually see the transactions by reading the blocks. And that way you can verify where the money goes. And that opens up a really like interesting opportunity for the payments to be a little bit more fair, or a little bit, at least, more open and transparent. As Ken mentioned, the fintech industry has seen a lot of healthy blockchain adoption because, a lot of like traditional fintech transactions require paperwork. They require a lot of licensing, a lot of verification of whether or not someone's accredited or meets certain requirements. You can now, and those verifications are usually done in person by a legal team or some certified person. You can actually bake those verifications into a blockchain through smart contracts. And that saves a lot of time. And that really will help make the finance and technology industry much more efficient by adopting those types of practices. And of course, the overarching thing with all of this is that you need to be very compliant, and you needed to be you needed to follow the rules in whatever jurisdiction that it's in, or else it's going to be an illegal activity. And I know a lot of people, when they think about Bitcoin, they think about the dark web, they think about a lot of like illegal drug trade and things like that. And that's really what we're trying to fight here. We want to make sure that we present blockchain technology and all of its applications in a very compliant way, so that it's ripe for adoption, right? No one's going to really massively adopt a technology that's shady. But if we do it the right way and we follow the rules as we do it, and maybe even create new rules, then it can really take off and be something that helps like change society and change like the landscape for the better. And with that, that kind of concludes my summary.
I would like to take this opportunity once again to thank our speakers as well as you, the audience. You've been amazing and engaged. We really appreciate you spending this time with us. And please never hesitate to reach out to us. On this page, you see our contact information, team@republic.co. If you have questions, ideas, or want to see classes, webinars that we can bring to you, please let us know. We would love to hear from you as always. And with that, thanks again, everyone, and have a great rest of your day. Bye-bye.
Bye, everyone.